to have a very good paper to discuss. Rakesh is also waiting in New Haven, and Barry has got up very early in Berkeley. So over to you, Rakesh. Again, standard 30 minutes, 10 minutes each for the discussants, and then a floor discussion. And with your permission and with the permission of all our participants, I hope you will stay, because we will want to stretch this out a little bit beyond the 9:30 time. I think it's a very useful paper, a very innovative paper, and I know that our two discussants also will have very interesting comments to make on the inflation targeting paper. So over to you, Rakesh.
Thank you very much, Shekhar. You were quite right in saying I'm waiting in New Haven. I'm waiting in New Haven to come back once you open flights to India. So I'm really waiting around here. Thank you very much, Shekhar, for asking me to chair this session. Let me first abuse this position by doing a one-line comment at the last discussion, which is just to say that I broadly agree with what Raghu said a few minutes back on the issue of financing, both on the issue of repair and relief, rather than as opposed to stimulus. And second, that yes, we shouldn't be that hesitant to for the central bank to finance the government if necessary. As it happens, given the kind of liquidity that has been induced including this, has been shoved into the system, that bond yields are very much under control. So there's no need in that sense for the government to borrow from the central bank. But if there is need, I think there should be no hesitance. Having said that, it is also somewhat relevant to the discussion today. I'm delighted to chair this session because it takes me back momentarily to the happy hunting grounds of the Reserve Bank that I inhabited for 7 years and in charge of monetary policy to boot. Veterans of the IPF are doing this paper on inflation targeting in India, and I think very correctly titled an interim assessment. And of course, the discussants, Ken Kletzer from the University of California, Santa Cruz, and Rajeswari Sengupta from IGIDR, but who also actually has her PhD from the University of California, Santa Cruz. So I wonder if Ken was a thesis advisor, so whether we'll get different comments or the same comment. Over to you, Barry and Poonam. How will you divide your time, or will just one of you be making the presentation? You need to unmute yourself, Barry.
So thanks, Dr. Mohan. What Barry and I have decided is that I'll go first. I'll take about 10 minutes. I'm aware that the audience is really excited to hear from Barry, so he will be taking 20 or so minutes. And if it's okay, I can start sharing my slides and can go into it right away. All right, so during my 10 minutes, I'll just give a short snapshot of what the paper is about and how we started thinking about this issue. An apology to those who don't agree with what we have found, and also a disclaimer that there were hardly any priors when we started the work. We let the data speak. There are no ideological underpinnings around this paper. If anything, my own priors were different, and I was quite surprised with the findings. And I was thinking of writing another paper, expecting another set of findings, but this is what we have, where we are letting the data speak for itself. And it was really good to have Barry in this very India-specific paper on its experience with inflation targeting, because Barry brought a lot more objectivity to the paper, and of course his cross-country understanding of the issue. So inflation targeting, for those who are perhaps not keeping track of how and when India implemented and adopted inflation targeting. India moved to inflation targeting framework in September 2016. It was after nearly 2 years of background work. We started with Patel Committee report, which was submitted in 2014. And it took nearly a year and a half after that to put the framework in place. The RBI Act had to be amended, which was done in May 2016. IT was formally adopted in September 2016. And the first Monetary Policy Committee was had its meeting in October 2016. Some of the key features, and by no means all of the features, but some of the crucial ones that the committee decided, the IT framework decided that it will be headline CPI price inflation, which will be targeted as compared to core inflation, which excludes volatile food and fuel prices, or as compared to the wholesale price inflation. So it was headline consumer price inflation, which was to be targeted at 4% within a band of 2 to 6. So there is flexibility for inflation to move within the band. A 6-member MPC, Monetary Policy Committee, was set up, out of which 3 members are from the RBI and 3 are appointed by the government. And the current MPC has 3 academics really in it and 3 RBI officials. RBI governor is the chair. Repo rate is the key policy rate which is used. And interestingly, the inflation target itself is coming up for a review in March 2021. MPC has been set up for 4 years, so there will be some changes in the MPC itself later this year. And these will be interesting times to watch as to how the composition changes and what happens thereafter. Just a slide on the relevance of inflation targeting in India, what has been India's record on inflation. And this chart is different from the one Dr. Mohan has seen in the paper. It's just a simple 5-year average of CPI, industrial worker, and thereafter CPI inflation. For most part, actually, during these 5-year averages, inflation has been about 8 or has exceeded 8%. 2 exceptions have been in the early to mid 2000s and in the last 4 years when inflation has averaged at about 4%. Now, if you do the averages over different periods, of course, you'll get different numbers because inflation has not necessarily been very stable and there are periods of very high inflation going above 10%, etc. In fact, the period before 2014, when there were talks were started about putting in place a more definite inflation targeting framework, inflation had exceeded 10% for a few years. And that was really the backdrop in which the framework was thought about. MPC has had 21 meetings until February 2020, which is pre-COVID. Since then, it has had 2 meetings in March and May. Interestingly, out of those 21 meetings, there was no policy change in 12 meetings. And these periods were kind of concentrated in the first 2 years. And that's an interesting observation, which we are not fully exploiting in the paper, but I'll list it as one of the areas of extension, perhaps. The rate was raised twice during these 21 meetings, spanning over nearly 4 years. Each time it was raised by 25 basis points. It has been lowered 7 times pre-COVID. And this action has been concentrated really in the last year and a half. 6 of those times, the policy rate was lowered by 25 basis points and once by 35 basis points. The response to COVID has been in comparison much more significant. Policy rate was lowered by 75 basis points in March 2020 and by another 40 basis points in May 2020. Now, some of the concerns that were raised and which was really the motivation for this paper regarding the IT framework. And these actually are not documented necessarily in a one or more papers, but these were the views expressed in the forums such as IPF or newspapers or in private discussions. So the concerns have been that monetary policy will place an unduly large weight on inflation and it will result in the neglect of output gap and even other considerations such as the exchange rate. Monetary policy will become too hawkish and that will not be good for growth. Another concern has been that food has a large weight in the headline CPI. And if anything, actually vegetables have a large weight in food, and vegetable prices are notoriously volatile. So the concern has been that monetary policy will be excessively influenced by volatile food prices. And I have been holding this view as well prior to writing the paper. And I have cynically commented to colleagues that in India, monetary policy is determined by onion prices. We don't find evidence for that, actually. Another concern is that 4% target is too low for a developing economy. It could be higher. Perhaps 5, perhaps even higher. And post-IT, one concern, again, I have been holding this concern as well, is that MPC or the RBI does not treat the band in a very symmetric way, that it reacts more when inflation is 4 or above, and it's very passive when inflation declines below 4%. So I have said actually that it's almost as if the inflation range, target range, is treated as 4 to 6 than 2 to 6. At least in the analysis we didn't find this bias in our results. So the way we have organized the paper, we look at different inflation series, WPI, CPI headline, food, core, and we asked whether there is a strong case for targeting core inflation instead of the currently targeted headline inflation. We estimate the reaction function, and we ask if the weight on inflation has increased post-IT to the neglect of output gap. We also try to understand how IT has potentially impacted economic outcomes, and there we are comparing a number of outcomes before and after the inflation targeting, not claiming causality, but still comparing average values before and after the IT. We also ask, and thanks to Shekhar for pushing us to work on this section, if the IT has been able to respond to the COVID shock well, or in principle, is IT flexible enough, nimble enough to respond to such a COVID shock? Does it have an inbuilt escape clause, or can it have an explicit escape clause? And Barry will be presenting these results, which I think are pretty interesting and relevant under the circumstances, and will suggest the way forward on some of the issues. Just a minute on the technical details so that Barry does not have to do the tedious task, and he can just straight away take you to the more interesting parts of the paper. CPI headline inflation is available from 2012. So whenever we construct and we refer to a CPI headline time series, we are combining CPI industrial worker before 2012 and CPI headline combined after that. WPI series, a unified series, is available for a longer period. The series is somewhat different from CPI headline in that it has a lower weight of food and a larger weight of manufacturing and very little weight of services. So services are including to the extent that they are part of manufacturing. There is no separate weight for services consumption. So it has its own dynamics, and we actually played with the data a whole lot to see how it correlates with CPI and where are the differences and why those differences emerge. And all of these technical details are in the paper for those who are interested. RBI, in a way, at least publicly, seemed to be monitoring or tracking WPI inflation before 2014. So when we do our reaction function estimates, we have many of our benchmark specifications are where we take this announced inflation rate, WPI before 2014 and CPI from 2014. Just again, some mention here of the robustness test that we have done on reaction function. We didn't run 2 million regressions, but we ran many regressions. So some of the technical issues that you may have, details are in the paper. We are happy to engage afterwards. Results are very robust, basically. So we note that in our analysis of all of these inflation series, we do not find food inflation to be more persistent than core inflation in India. If anything, again, to my utter surprise, food feeds into core inflation, not the other way around. Onion prices are not driving India's monetary policy. So just to give a precursor of the main findings, which Barry will do more justice to, we do not justify excluding food price inflation from the inflation series that is targeted by the MPC/RBI. If anything, food feeds into core inflation and therefore should be a part of the targeted inflation series. We do not find that the RBI or the MPC has been obsessed with inflation. If anything, it has responded less to inflation than before. And for that, one just has to look at the last year and a half to pre-COVID, and which we take as evidence that there is greater anti-inflation credibility, which gives the RBI the space to actually respond to output gap. Inflationary expectations have become better anchored. There are issues with household inflationary expectation series. And if one were to talk about what elements of the framework needs to be strengthened, household inflation expectation series is something that can be improved, certainly. But a whole host of other financial variables are looking less volatile and therefore better outcomes. We do not find IT to be a hindrance in the response to COVID. And in cross-country comparisons of policy response to COVID of IT and non-IT countries, we find that IT countries have been able to respond a little bit more. Caveats are important. And again, to say, Barry, the drudgery of this, caveats and limitations are 4 years is not a long enough period. We absolutely understand. This is the period we have. And it's interesting and I think useful to look at the performance of the framework, even in the last 4 years. And it remains to be seen whether similar outcomes and discipline would be seen in coming years. Even during the short period of 4 years, there has been a change of the governor and deputy governor, which might have influenced the outcome. Again, 4 years is short enough period that we do not really have the flexibility to divide it into different MPC composition. Another interesting thing is that for most part, RBI votes as a block. So it's perhaps RBI versus the rest of the committee. And that has interesting, I think, implications for how the decisions have been taken. Another is that in most of the work that we are reporting in the paper, we are treating as if India moved to IT from 2016. And one could argue that India had started moving in that direction in 2014 itself. And what happens if you bring the date forward by 2 years? And we have done that, results are similar. And indeed, there were elements of moving in some kind of a soft or de facto inflation targeting without the trims and frills of it. Another caveat, of course, is COVID is still evolving, and isn't it premature to analyze the impact? And for that, we hold Shekhar responsible. He asked us, we did this analysis, but we like what we did, and we'll be extending it going forward. So I'll stop here and over to Barry.
Thank you very much, Poonam. Barry, please go ahead. Poonam did go over 5 minutes, but you should take it still at least 20 minutes.
I don't know that I need the 20 minutes. Poonam did an excellent job of summarizing the entire paper. Maybe I can take advantage of that fact by providing a little bit of additional context. We started this project, I think, Poonam, about 6 months ago, prior to COVID, and it feels a little bit strange to present it in the midst of a pandemic. But I do think, as we already heard toward the end of the last session, it's relevant to current.
Could you move to the full screen version, Barry?
Pardon me?
Could you move to the full screen view?
I don't know.
Just start the slideshow. Yeah, just start the slideshow. Yeah.
Yeah.
And from the beginning, yeah.
You guys are really sticklers about.
Thank you. It's much easier to read now. Thank you.
PowerPoint. I personally like to know what's coming on the next slide, but be that as it may. The connection with current events obviously is that central banks have played an important role globally in the response to the pandemic, and the RBI has played an important role in the response. At the same time, my casual reading of the Indian press is that there's some dissatisfaction with its response, some dissatisfaction with the system, and as Poonam said, there's a review of the inflation targeting framework coming. So all that makes it timely to review experience to date and think about what's coming. I would echo what Poonam said about looking at the response to COVID. It's absolutely premature to evaluate the Reserve Bank's response to the pandemic, but it would be derelict not to talk about and think about that topic in the context of the present paper. Paper is hard to summarize. Poonam did an excellent job, but there are 12 figures, 15 tables, lots of additional analysis in the footnote. So I'm happy that everybody on this call has read the paper thoroughly before we discuss it. The one thing Poonam didn't really detail was what we mean by inflation targeting or an inflation targeting framework. And the answer is that it means more than simply a point or range target for inflation, but it involves also an inflation forecast, an explanation for that inflation forecast and policy, an explanation for why the central bank missed its target, if it indeed missed its target, explicit linkage between policy instruments and outcomes, and transparency about that linkage and more generally about the conduct of monetary policy. Findings, Poonam summarized, we find that inflation expectations have become better anchored in the last 4 years. We find that a range of financial variables have become less volatile in the last 4 years, as well a subset of non-financial variables. We find that the Reserve Bank is not what Mervyn King would call an inflation nutter that responds only to inflation, but it responds to the real economy, to output fluctuations as well. We find, if anything, the bank responds less to movements in inflation now than before, because we believe it can afford to respond less to movements in inflation than before. Inflation expectations have become better anchored. The Reserve Bank has greater anti-inflation credibility. More controversially, perhaps, we pushed back against the view that the central bank should look through volatile food price inflation, as is the practice, say in my country, the United States, and focus on core inflation. We find for India, to the contrary, that food price inflation can spill over into core inflation, potentially de-anchoring expectations. And the implication of that is that the Reserve Bank should respond to food prices. And we provide some very preliminary evidence that credible inflation targeting central bank, under which heading we would place the RBI, has more room to respond to COVID-19 than your run-of-the-mill emerging market central bank, which has enabled the Reserve Bank to loosen in response to the pandemic, despite the fact that inflation was already running at the top of its target range, is now running above. We learned, what was it, yesterday or the day before, depending on your time zone, despite the fact that inflation is now running above the top of its target range. So we analyze the stability of various outcome variables, financial variables, and non-financial variables by essentially distinguishing a subset of different periods. We look at the longest period for which we have reasonably consistent data from 1996 through the end of last year. And what we essentially do using simple equations of this sort is look at the pre-global financial crisis period, picked up by the constant term, at the global financial crisis itself, 2008, 2009, at the post-global financial crisis period, and then we break the post-global financial crisis period into the inflation targeting 4 years and the period before that. And here it's alpha 1, the coefficient on the inflation targeting subperiod that's of particular interest. So when we do that, what do we find? We find that with the shift to inflation targeting in 2016 or 2014, depending on what you prefer, the average rate of inflation has fallen. Inflation has become less volatile. Government bond yields have declined. We find no impact on external variables like the rate of change, average rate of change of the exchange rate, the change in foreign reserves, portfolio capital flows, but with one important exception. The exchange rate itself has become significantly less volatile with the shift to inflation targeting, as have several other financial variables. Equity prices have become less volatile. The call money rate has become less volatile. And again, you might think that this is attributable to the contrast between the global financial crisis period and the recent period, but we are expressly controlling for that in the way we have separate variables for those separate subperiods. On the real side, it's not as if the same volatility being suppressed on the financial side pops up on the real side. To the contrary, output, industrial production is the measure available on a quarterly basis, has become significantly less volatile. And there's no change in the average rate of growth, the change in the level of industrial production quarter over quarter, nor is there a significant change in the components of the budgetary accounts. So we think that the explanation for those findings, including the fact that output has become less volatile, is that the RBI as a flexible inflation targeter is responding to output fluctuations as well as to inflation. And that's what we find when we estimate textbook reaction functions for the central bank. So here in the various columns are examples of the many, many reaction functions that we looked at in the course of this work, where the policy interest rate is the dependent variable, the output gap and the rate of inflation are the standard independent variables. And we allow the reaction to the output gap and the reaction to the inflation rate to differ in the inflation targeting period relative to the period that came before. We do not find that the Reserve Bank has become fixated on inflation to the neglect of the output gap with the transition. There's no change in the Reserve Bank's responsiveness to the output gap post-inflation targeting. But we do find, as I said before, a smaller reaction to movements in inflation itself, which I think is best interpreted as greater anti-inflation credibility post-IT. And again, there are a large number of robustness checks, sensitivity tests that confirm the generality of those findings. We looked, as Poonam said, for asymmetries. We investigated the criticism that the RBI is more inclined to raise policy rates when inflation is above 4% than it is to cut them when inflation declines toward or below 4%. And we did not find any evidence of such asymmetries. So again, maybe 4 years is too short a period to turn up significant results, but we do turn up a variety of other significant results, just not this one. Consistent with this interpretation of greater anti-inflationary credibility, we find some evidence that inflation expectations have become better anchored post-IT. We have survey data for a shorter period on households' inflation expectations and separately professional forecasters' inflation expectations. So we regress expected in inflation in the future on current inflation and look separately at that reaction, the reaction of expectations pre and post inflation targeting. There's no change for households, which is a little disappointing perhaps if you're a believer in this framework. But for professional forecasters, the response is significantly less post-IT. When inflation accelerates, professional forecasters expect the central bank has credibility in their eyes that it will step in and damp down that increase in inflation. Further consistent with better anchoring, we find less of a tendency post-IT for expected inflation a quarter or two ahead to feed expected inflation now to feed through into actual inflation in the future. And here we find that for professional forecasters, as before. We find it also for the expectations of households. We think that this better anchoring of expectations and this improvement in central bank credibility has allowed the RBI to respond better to exceptional shocks, where COVID-19 is the obvious case in point. You can see here that inflation was running toward the top of the target range when the pandemic struck. In my view, the initial effect of the pandemic was felt as a negative supply shock, the lockdown and all that. A negative supply shock, if a negative supply shock dominates, you would expect more inflationary pressure. So we got a bit of pushback from readers and friends on that point. But I think that's what we have now seen in the data. Food prices, which was the first data point we all had, rose by 9% in May. And we've learned that the CPI rose by 7% in April, 6% in May, and 6% again in June. If the central bank lacked credibility and saw inflation accelerate, there would be real worries about expectations and actual inflation becoming unanchored. A central bank facing that problem would be reluctant to cut rates. The RBI cut rates, which I think is the fruit of the credibility built up as a result of the framework. More generally, you can look at some cross-country evidence distinguishing emerging market central banks that have an inflation targeting framework from emerging market central banks that don't operate such a framework. Their policy rates were broadly similar at the end of the last year before the pandemic erupted. Their actual inflation rates were broadly similar at the end of last year before the pandemic erupted. But the reduction in policy interest rates between then and now, actually between then and May of this year, was greater for inflation targeting central banks. Again, a suggestion that this greater credibility is a more general feature of an inflation targeting framework. So we can try to control for some of those other monetary and economic conditions explicitly. We can take these 70 data points about what central banks have done in the first 5 months of 2020 in response to the pandemic. We can control different regressions in different columns. We can control for the level of the policy interest rate at the end of last year. We can control for the actual inflation rate at the end of last year. We can instrument the inflation targeting dummy because we know adoption of this framework is not randomly assigned, that small economies are more likely to do something else, like peg the exchange rate, that the quality of regulatory institutions, transparency more generally, are associated with the adoption of inflation targeting. And when you do all that, you get results like these, which show that inflation targeting central banks have been able to reduce the policy rate significantly more, by 50 basis points more on average, controlling for these other conditions in the first 5 months of 2020. So that leads me finally to the other demand of our organizers, which was to provide some suggestions for the future and for the upcoming review of the framework. And my number one recommendation would be, don't try to fix it because it ain't broke. It seems to be operating reasonably well and generating a payoff. There are, in particular, do not abandon the focus on headline CPI. Headline CPI has a relatively heavy weight on food prices. And we find that that weight on food prices is justified because when food prices rise, they feed through into core inflation and can potentially de-anchor inflation if the central bank doesn't take that information about food prices into account and react to it. So here, Poonam, I think you and I are expressing the result in a slightly different way, but we agree on this implication. There have been a number of suggestions about other things that the RBI ought to do differently and other ways in which the framework should be revised. And I, for one, don't subscribe to those other things. So there's the widely heard view that a higher target would be better. Why would a higher target be better? The basic answer is that the central bank has to have sufficient room to cut the rate by a certain number of basis points in a serious downturn or in deflationary circumstances. The RBI is not at or near the zero lower bound. It's experienced a significant shock. I think that the deflation is still coming, to be sure, as the negative supply shock is now matched or perhaps exceeded by a negative demand shock. But so far, I don't see evidence that the zero lower bound is going to be a big problem for the RBI. It has been argued, Poonam pointed me to a couple of newspaper reports where eminent economists who shall go unnamed argued that inflation targeting disadvantages the rural sector as well. I will admit that I don't understand that argument completely, but I do think that if there are concerns about the state of the rural sector and how it is doing when inflation is running at 6% or 5% or 4%, those allocation decisions, subsidy decisions should be left to the government, and the RBI should stick to its knitting, which is to target the inflation rate, target the, react to the output gap economy-wide, and worry about the functioning of the payments and financial system more broadly, and leave helping the rural sector to other branches of government which properly have that competence. So I hope that's plenty for the audience to chew on, and I look forward to our discussants. I should close with one more observation, which is that I'm a graduate of UC Santa Cruz as well.
Barry, also a graduate of Yale University. You forgot to mention that for your PhD. Thank you very much, Poonam and Barry, for really quite an amazingly succinct and clear presentation of a relatively complex paper. I learned something from you both in terms of substance, of course, as well as how to present such a paper in such so succinctly, but also bringing out the complexities that are inherent in your paper. Ken, may I ask Ken Kletzer, can I ask you to be the first discussant? You have 10 minutes.
I think you can hear me.
Yeah.
And Barry, if you could turn off your screen sharing. Yeah.
I will. I can't compete with Barry's presentation or Poonam's, but I am not going to use slides. I'm going to read through a text, having exhausted myself teaching with slides for 3 months. I want to start by thanking the editors for having me discuss this paper. Barry, Poonam, and Rishabh have written an exceptionally clear, informative, and thorough paper integrating empirical analysis with insightful and well-supported interpretations. I'm particularly interested in having an interim assessment of inflation targeting for India available. It does seem early to perform an interim appraisal of a monetary policy regime that has not quite completed its 4th year, but inflation targeting in India will face review in 2021, so it's timely. Although less critical than public health and other interventions to alleviate individual hardship, monetary policy everywhere is tackling a major macroeconomic challenge due to COVID-19. The authors wisely combine a discussion of the role for monetary policy in the present crisis with a retrospective analysis of the current policy regime. The result is a valuable analytical paper that's accessible and informative to policymakers. The appraisal of inflation targeting in India follows well-used, appropriate empirical practice in this area. It also follows a substantial literature on Indian inflation, the importance of food price inflation in India, and the effects of adopting inflation targeting for emerging market and middle-income economies. I discussed the paper following 4 topics. The first concerns the appropriate measure of inflation. I have to scroll this. Of inflation to adopt as the operative inflation target. The paper begins with an overview of the comparison of the Unified Consumer Price Index, component-wise CPIs, and the WPI, and provides a very clear explanation why the CPI is the more meaningful and useful measure of inflation for India. This is expected, but it is convincingly done. The authors then address the attention given to food price inflation by policymakers and commentators. The authors' comparisons of the volatility, persistence, and interactions of food inflation, core inflation, and headline inflation replicate somewhat and update the findings from others, including 2 previous IPF papers I want to point out. Food inflation remains less persistent than headline or core inflation, and the volatilities have quite similar magnitudes. As Poonam and Barry pointed out, right, this is contrary to what people seem to think in the press, but it's not contrary to the findings, previous findings in the literature. Combining the CPI and the CPI for industrial workers to get a longer time series, Barry, Poonam, and Rishabh show that food inflation predicts core inflation, but core inflation does not predict food inflation. They conclude that the standard inflation measure, all items less, that is core inflation measure, excuse me, all items less food and fuel provides an inferior inflation target than headline inflation, which incorporates the long-run effects of food inflation. Although the Granger causality tests in the text is supplemented by vector autoregressions in the appendix, earlier papers have also demonstrated these results using co-integration and vector error correction models. Among these is the 2011-12 IPF paper by Prachamishi and Devash Roy, who also argue that because the conventional exclusionary measure of core inflation does not converge to headline inflation in the long run, headline inflation is the more appropriate measure for an inflation target in India. Lawrence Ball, Anish Achari, and Prachi Mishra in the 2015-16 IPF used disaggregated sectoral price data. They have 61 and 81, depending on the time period, industries. And they proposed the use of a trim mean or median inflation as a better guide for targeting inflation. One observation they make is that food and fuel together contribute about 2/3 of the upper 10% tail of quarterly price changes. This is consistent with similar volatility and shorter duration of food price shocks that are shown by Barry, Poonam, and Rishabh. Balchari and Mishra, however, use the Phillips curve to assess the choice of the core inflation measure, that is a structural equation. I recommend adding references to both papers, perhaps including some comparisons to the present analysis. There are also 2 recent RBI papers published this year I recommend taking a look at. I'll give those later. Although it is common, I recommend a little temperance using the phrase the pass-through of inflation to describe Granger causality. There's a natural explanation involving price and wage setting behavior, why food-specific shocks such as weather cause overall inflation to rise. But the test just shows prediction. Further monetary policy reaction functions should affect the statistical relationship. The second point in the paper concerns the importance of output growth, or the output gap, in the Reserve Bank's policy goals under inflation targeting. The RBI implements a flexible inflation target. The paper does a convincing job demonstrating so by showing that the output gap plays no less of a role in determining changes in the effective policy rate after the inception of inflation targeting than before. The monetary policy rule regressions further confirm that policy rate changes respond to headline inflation and not separately and additionally to food inflation. Hopefully, writers in the business press will take note. Sections 5 and 6 address what I think is the third major point. This is the assessment of the performance of the inflation targeting regime. This is, of course, what Barry concentrated on. Does it appear to be a success so far? As we go through Section 5, inflation in the CPI, as well as headline core and food inflation, are significantly and economically lower after inflation targeting than before, whether the change in the policy regime is dated at the start of 2016, formal start, or when the RBI began adopting the procedures of inflation targeting in 2014. The volatility of all measures of inflation, with the exception of food inflation, are also lower. The overall absence of effects on exchange rates, foreign reserves, and portfolio flows, as well as the reductions in the volatility of exchange rates, the stock market, and the call rate, are all checks on the plus side for inflation targeting. Indeed, India fares better than most emerging market and middle income countries in the various cross-country studies compiled in the appendix. It seems to me that inflation targeting is doing very well so far. Another important question in this assessment is whether progress has been made towards anchoring inflation expectations since the adoption of inflation targeting. The evidence is ambiguous. The survey of inflation expectations for households continues to illustrate tremendous persistence in their inflation expectations. The slow decline in expected inflation in response to the decrease in inflation over several years, and the large 3% difference between the inflation rate expected by households and actual inflation are disconcerting. Since the introduction of the RBI's survey of inflation expectations for professional forecasters, actual inflation and expected inflation for the professional forecasters have tracked quite well. The progress towards the anchoring of expectations is clouded by the absence of a significant effect of inflation on expected inflation, shown in Table 14, and of expected inflation on actual inflation for households, shown in Table 15. Those are both for households, excuse me. The positive results for professional forecasters are encouraging, but we do not understand how inflation expectations by households are formed, nor can we yet learn how important this discrepancy might be in the presence of inflation shocks following expansive monetary policies in the near-term responses to the pandemic. A question left unanswered is which group's expectations matter more for the impact of expected inflation on current inflation. This has to do with who sets which prices and wages. I'm unaware of any adequate analysis of the relative importance of professional forecaster expectations to help or offer. I really appreciate that Barry, Poonam, and Rishabh present their analysis of whether expectations are becoming more anchored carefully and clearly and forego reaching conclusions not yet ready to be made. The fourth major contribution to the paper is the discussion of the monetary policy response to COVID-19 in India and escape clauses for inflation targeting central banks in the face of force majeure. As noted by the authors, India, like other emerging market and middle-income countries, has acted quickly in its monetary policy response to the pandemic by lowering policy rates 4 times since February, with large decreases each time. They argued that the RBI has some room to cut rates with inflation just at the upper bound of its target range of 6%. The paper nicely uses standard textbook aggregate supply and aggregate demand models, to explain how the timing of the supply shock and the demand shock will determine qualitatively how inflation policy rate cuts will be. I think this is the right explanation and the right way to communicate it. A central bank that enjoys anchored expectations under inflation targeting will have the credibility to use forward guidance to mitigate the inflationary consequences of an expansionary monetary response to a temporary supply shock. The authors close the paper with an insightful piece of empirical evidence in favor of inflation targeting. Table 17 shows that inflation targeting central banks have been able to lower their policy rates more aggressively since the onset of the beginning of 2020, really the onset of the pandemic at the beginning of 2020, than non-inflation targeters. The paper points out that if the disruptions to production and trade persist, then monetary policy in response to supply shock should be contractionary. With a persistent pandemic, potential output falls or will fall. Thus, the output gap rises, and the monetary policy rule instructs the central bank to raise policy rates. In such circumstances, as in the advanced economies in the 1970s, rising inflation is likely to lead to a loss of central bank credibility and de-anchoring of expectations. At the end, the paper raises the possibility that the theory of repeated games, albeit from a long time ago, may be useful for communicating departures from monetary policy rules under exceptional shocks. Several game theoretic analyses of the conflict between commitment and discretion in monetary policy making have been published in recent years that show monetary policies can allow central banks to use the private information about the state of the world. My examples are Athy Atkinson and Kehoe, as well as Amador Vernin and Angelitos. An implicit escape clause that allows the central bank to deviate from inflation target, in exigent circumstances observable by all, will work in a basic reputational equilibrium in repeated games. Rules that allow flexibility are possible and still rely on reputations, as in the papers I cited. This may be an exotic literature, but difficulty for policymakers in any kind in the face of uncertainty rather than risk is a problem likely to be with macroeconomics for some time. In summary, I found this to be a superb paper on monetary policy in the context of emerging market economy, containing a very large number of important results. The text is thoughtfully written so that it'll reach policymakers and other observers without sacrificing sufficient empirical analysis and appropriate econometrics and interpretations. I'm hopeful that its main message will find a grateful audience.
Thank you very much, Ken, for that very, very thoughtful and detailed analysis of the paper, and you added further to the quality of the paper in a sense. So Rajeswari, can I ask you to now go ahead?
Thank you so much, and sorry for that minor glitch. And thank you so much to the organizers, especially to Dr. Shekhar Shah, for inviting me to discuss this paper, which indeed is a very interesting read. And it's an honor, of course, to discuss it along with Ken Kletzer in the same panel, who was indeed my professor at UC Santa Cruz. And I must congratulate Barry, Poonam, and Rishabh for having written an excellent paper. Can we just go to the first slide? I'll quickly summarize the findings of the paper, which of course Barry and Poonam both have presented very eloquently. What they mostly find is that the RBI has been a flexible inflation targeter and has not neglected changes in the output gap when setting policy rates. It has not been an inflation hawk, contrary to what was criticized. And in fact, it has adjusted policy rates by less in response to inflation. The authors interpret this as an increase in policy credibility, saying that smaller changes are needed because RBI had the credibility. And they say that inflation expectations, they find that they are better anchored, and other inflation-related outcomes, most notably exchange rate, are more stable than before. Can we go to the next slide? The essence of the paper, as I understood it, is that the RBI has established credibility as an inflation targeting central bank. As a result of the enhanced credibility, therefore, RBI has more room to cut policy rates now. And in context of the current extraordinary circumstances of the pandemic, the RBI is in a position to disregard inflation target and temporarily exceed the target. It's a very, very detailed and thought-provoking paper with a very comprehensive and perhaps the first comprehensive assessment of the inflation targeting framework in India. Can we go to the next slide, please? My main comment on the paper has to do with the major claim of the paper, which is that the RBI has achieved credibility as an inflation targeting central bank. And I'm a little bit skeptical about this claim, and I'll just very briefly elaborate on this. A good way to assess performance is by looking at inputs rather than outcomes, because outcomes can be affected by exogenous factors, be it the level of inflation or inflation volatility can be affected by factors which are exogenous. Two important inputs to develop policy credibility are one is the technical ability to deliver on the objective, and the second is the demonstrated commitment towards the objective. And I think in the last 4 years, there are significant questions that remain on both grounds. Let's go to the next slide. So the first input, which is whether RBI has demonstrated the technical ability to achieve its inflation target. I have 3 specific points here. The first has to do with forecasts. As we all know that policy rates are decided on the basis of macroeconomic forecasts. The RBI or the MPC has systematically and consistently, and this is what the data shows, has overpredicted the output gap and the inflation gap. I have a brief chart here which shows the RBI forecasts of GDP growth rate, which are the gray bars, juxtaposed against the actual GDP growth rate, which are the orange bars. And you'll see that especially for the last 3 years, from 2017-18 onwards, there has been a systematic overprediction of the GDP growth rate, as a result of which the MPC, the RBI, has had to revise the growth forecasts multiple times. Most notably in 2019-20, the growth forecasts were revised as many as 4 times, from 7.4% to 5%. Revising forecasts is perfectly all right for central banks, they do it all the time. But I think what has caused concern is the magnitude and the frequency of revisions in RBI's forecasts. And throughout the last 3-4 years, concerns have been raised in media reports and analyst reports alike about the MPC and the RBI missing the forecasts on both output and inflation gap consistently. Let's go to the next slide. My second point about the technical ability to achieve the target has to do with the kind of data that is used to do the forecasts. Of course, RBI has been operating on the basis of the 2011-12 base year GDP data, which, as we know by now, has been highly controversial. In fact, we presented a paper in the last IPF which detailed all the problems with the GDP series, which most likely has overestimated the growth rate of the country. So if the official data did not convey the true picture of the economy, it is possible that the RBI forecast that output gaps would close, and that would push up inflation sharply. This resulted in the pursuit of excessively tight monetary policy. There is a recent paper that has come out by Bhoy et al., it's still a working paper, which estimates the Taylor rule and finds that the predicted interest rate has been higher, much higher than the actual interest rate of the RBI. In fact, if I just look at the raw data between September 2016 and March 2019, the real interest rate was as high as 3.2%. This was at a time when growth has been declining and investment has been falling. And that has been a very big cause of concern in the market participants as well. Let's go to the next slide. The next slide, please. The third point I have on this, there is another slide before this. So the third point I have on this technical ability is to do with monetary policy transmission. And this was discussed by Prachi yesterday in her presentation as well, that monetary policy transmission has always been weak in India. And this is not improved with the advent of inflation targeting. In fact, in the last 1 year itself, while the repo rate has been cut by more than 100 basis points, the lending rate of banks has barely come down by 40 basis points. And in absence of an effective monetary policy transmission, achieving the inflation target through policy rate changes becomes difficult. And this further raises question about the ability of the RBI to deliver on the objective. So these are 3 specific points on the technical ability. Let's go to the next slide. On the second input, which is whether the RBI has demonstrated commitment to inflation target, I'll just make 2 specific points, which is one has to do with RBI's liquidity management. And if you look at the data, there are multiple instances where the liquidity management has often contradicted the MPC's interest rate decision. Of course, liquidity management is done to influence the long end of the yield curve, whereas monetary policy is essentially about the short rate. But if they are in conflict with each other, that can send mixed signals to the market. I've just cited one example where in 2017 fall, the MPC had lowered the repo rate, and this was the first time they were lowering the repo rate since the MPC had been formed. But the RBI conducted an open market sale, which translates to a monetary policy contraction. And this kind of a conflict would basically make the banks confused because they don't know whether RBI is serious about the easing. And because they are facing a liquidity deficit, they will not be able to lower the deposit rate and accordingly the lending rate. So that hampers the transmission of the rate cut to lending rates. There are multiple such occasions where the liquidity action adopted by the RBI has been in conflict with the interest rate decision taken by the MPC. Let's go to the next slide. The second point about input is about demonstrated commitment, is about communication. There is a large literature which is developing as we speak about the importance of communication in order to help central bank establish its credibility as an inflation targeter. When I look at the amended Act of 2016, which amended the preamble of the RBI Act, it says the primary objective of the monetary policy is to maintain price stability while keeping in mind the objective of growth. So in a way, the Act itself talks about a flexible inflation targeting framework, so that's nothing surprising. But what has happened is in recent times, for example, a current governor in multiple occasions in communication has communicated otherwise. In fact, his maiden speech in Jan 2019 is what I have in the second bullet point. But in the interest of time, I'll just summarize it. So that's the last bullet point, where he said that the central bank would be flexible enough to assume multiple responsibilities instead of the one-point agenda of remaining fixated on inflation. This was picked up by all leading financial dailies and were discussed by analyst reports as well. The idea that perhaps the RBI is no longer just focusing on inflation target and is looking at other objectives, for example, financial stability. And this would again undermine RBI's attempt to establish credibility as an inflation targeter in less than 4 years of having adopted the framework. Let's go to the next slide. So now the authors, what they primarily do in the paper in order to establish the inflation targeting assessment is they estimate the Taylor rule function, which is quite standard in the literature. Now, if the RBI was focusing on inflation, then we should see an inflation coefficient of greater than 1 in the Taylor rule. Or at best, we should see that the size of the estimated inflation coefficient should have gone up in the aftermath of adoption of inflation targeting. What, however, we find is that in the paper, the relationship between inflation and the policy rate becomes weaker right after adoption of inflation targeting. Now, this actually threw me off a bit because then how do we interpret RBI's pursuit of inflation targeting? Was it really focusing on inflation at all after adopting inflation targeting? Now that's what the paper is talking about. And also, what does it mean about RBI establishing a credibility? The authors interpret that because the RBI achieved credibility, it had to change interest rates by less. But once again, what is the evidence that the RBI achieved the credibility? Just by the mere act of adopting a framework or changing the law doesn't really give credibility, which can take years to demonstrate and to achieve. So it's not clear that if the RBI was not explicitly focusing on inflation, as we see from the Taylor rule coefficient, then how is it that the RBI had established its credibility? If it's going to be about inflation expectations, once again, it's not clear that inflation expectations explicitly came down of the professional forecasters as a result of inflation targeting. I think that there's no, the evidence is not as conclusive. And as Ken mentioned, that for household inflation expectation continues to be very high and persistent. So this part I thought was a bit confusing in the paper. In fact, they do find in the IT period, the effect of inflation on policy rate is negative. It is a bit odd to find the negative coefficient in a Taylor rule estimation. And it may help with authors elaborate further a little bit on this point, because this does contradict actual data, which I said the real rate actually has been very high because RBI had pursued an excessively tight monetary policy at least till March 2019. And even existing research which finds that the rate predicted by the Taylor rule has been much lower than the actual rate decided by the MPC. Let's go to the next slide, and I'll just finish in a minute. I have some other minor quibbles, which is that the paper does a whole lot of things, and therefore it's very, very comprehensive, but it may help to bring out the objective a little bit more clearly, which I think Barry and Poonam did an excellent job in presenting, and it will be great to reflect that in the paper, because there was a lot of discussion about which index the RBI is targeting, about inflation expectations, about the GFC period, about the Taylor rule, and it might help to just sharpen the focus a little bit. For example, to say, what are the specific metrics that are being used to assess the IT framework? That was not clear. Also, it may help to include some discussion on relevant variables which may have played a very important role in lowering inflation around this time, such as low oil prices, low commodity prices, record levels of food grain production. All of these exogenous factors may have actually influenced the inflation level and volatility much more than the action of the RBI. A few technical quibbles on Taylor rule. It may help to use the 91-day treasury bill rate as the dependent variable as opposed to the policy rates, because the RBI has multiple instruments to focus on inflation and output gap. And the T-bill rate captures all of that, including changes in CRR, liquidity management, etc. It may help to include exchange rate change in the baseline model, because that is a constant variable that the RBI does look at, irrespective of what monetary policy framework is being adopted. And I know in my past research, the exchange rate does figure as a very important variable in the Taylor rule. And finally, it may help to use the same inflation for consistency instead of having WPI for some years and CPI for some, because when I've analyzed RBI's monetary policy statements for the last 20 years, RBI does speak about WPI and CPI in all the statements. Finally, the authors say that the exchange rate stability is an indicator that things are working well, but I don't think that's proof of RBI's credibility as an inflation targeting central bank. It has been stable because the RBI has been intervening in the currency market. In fact, if anything, it would call into question RBI's commitment to inflation targeting if we think about the classic impossible trilemma framework. Lastly, I would like to, let's go to the final slide. In context of what the authors have talked about in context of COVID, of course, this may be contrarian to what the participants and the panelists would think about, but I think both Barry and Ken touched upon this a little bit. The experience of the post-GFC period might be worth keeping in mind. The authors do say that RBI has the credibility now to cut rates as much as possible. Even in the post-GFC period, there was a certain amount of complacency regarding inflation. The RBI had lowered the repo rate significantly and had done massive amounts of liquidity infusion. In fact, the repo rate was down to 4.75%, which is very similar to where the repo rate stands today, which is around 4%. Once again, uncharted territory was cited, and hence erring on the side of caution was justified back then because it was an exceptional circumstance. Inflation went up from 6.2%, exactly what the CPI inflation is today, to 12% by 2009-10, and we all, I think, know what happened. The economy had to bear a severe cost of bringing inflation down, and the RBI's monetary policy was behind the curve because there was a lot of delay in response. So I'm not saying that that's exactly what's going to be replicated, because of course it's possible deflationary pressures may set in, but at the same time, inflation in India is highly influenced by supply shocks and has very strong persistence. And hence we perhaps should sound a bit of a cautionary tale before embarking on an excessively loose monetary policy. So that's what I would end with. And once again, thank you so much for giving this opportunity. Thank you.
Thank you very much, Rajeswari, for those very, very detailed remarks and empirical and reporting your own empirical work. And of course, it's always a good idea in a discussion to have a contrary view from the paper presenters. If I may take the liberty of perhaps asking Raghu to start off with some comments.
Sure. I don't want to comment generally on the paper. I think it's a very good paper, and I've already given some comments privately to Barry. I think it's an important contribution at this juncture because of the review that is coming up. It is obviously there's not enough data to make a full judgment of whether it's worked as advertised. But certainly we have to start thinking about it because of the review, which was implicit in the move to inflation targeting itself. On the, I think the paper makes the very important point that RBI is a flexible inflation targeter. That is, it's not an inflation nutter focused only on the number, and it's trying to get us within that range over a period of time, even if we are sort of moved away by shocks. So that's something that people don't fully understand sometimes, that the RBI cares about output also. It's not completely sort of hasn't closed its mind to it. It's just that it believes that getting inflation within the target zone is probably the best way to enhance output over time. You know, I mean, one could look at one of their early tables and say, well, you know, why are we so anti-inflation targeting when we see that, you know, it has actually brought down, or it's been associated, I should say, with the decline in inflation over the last few years. Remember, when we moved towards CPI headline inflation targeting, people said, you're crazy. There's no way you can bring down CPI inflation. You'll be buffeted by food prices. This will happen, that'll happen. But inflation has come down. So whether it's because of inflation targeting, whether it's because of other forces, still too early to tell. But it certainly hasn't hurt, and that's one important point to keep in mind. The other is there've been many important sort of shocks during this time. Bank distress has been an ongoing problem. Rajeswari talked about transmission. With bank distress, very difficult to get transmission. So you're working more on expectations rather than through interest rates, the lending rates being affected directly. And so I think the evidence on professional forecast expectations is important. We always knew we could communicate with them. The difficulty is that it doesn't seem to have percolated to household surveys. And the household surveys, if you look at the RBI's household surveys, are extremely noisy. You know, at one point, the median, I don't remember whether it's the mean or the median, but the median inflation expectation of households was higher than what it had been over the last 10 years. So it's not clear that what we're picking up in the household survey, and it's very hard to move it. And I'm not surprised that the authors find that, but professional forecasters seem to get it. And then the question is, how does that transmit into wage setting, into bond market prices, and so on? Now, in terms of the issue of how good the RBI has been at forecasting, I mean, I'm not trying to make excuses for the RBI, but as Dr. Reddy famously said, in India, it's not just the future which is uncertain, but the past is uncertain. Given how many revisions we've had to GDP, as well as the new method of calculating GDP, which is not very, very well understood, at least for some time, I think some error is excusable, but I don't want. I think it's an important issue, and it is worth looking at very, very carefully. Has RBI got credibility? Again, I would say it's too early to tell, but you're not going to get credibility by changing the system too rapidly. I would say let the system establish itself. I would agree with Barry and Poonam in saying that the RBI has a little more room now. I would also agree with Rajeswari that you can't exploit the room too much without being confident you have that credibility. You don't want to see inflation sort of break out again. But I would certainly say the institutional structure has helped the RBI get some credibility at this point, that it will revert it will bring inflation back. I think at least in the early stages of the pandemic, there is some belief that the demand compression will be more than the effects on supply. Certainly, that's been the early evidence from the industrial countries. It may well hold in India also. So it may be that despite us being outside the range right now, it'll come back. But nevertheless, I agree with the point that it's important to be cautious and not to take credibility for granted. But those are, Rakesh asked me to intervene, and those are my 2 cents at this point.
Thank you very much, Raghu, to get over your reluctance to speak, which I'm glad you did. Sajid?
Yes, thank you, Rakesh. Can you hear me?
Yeah.
Well, I want to congratulate Barry and Poonam for a very interesting and timely paper. I guess I just want to focus on 2 points. One is this very interesting and counterintuitive result that post-inflation targeting, the coefficient on inflation in the Taylor rule actually either becomes insignificant or is diluted. And I want to offer 4 kind of hypotheses / suggestions to test the robustness of this result. First, I believe is you're checking the contemporaneous relationship between inflation and policy rates. But in fact, we know that under inflation targeting, you're looking at inflation 4 quarters ahead, 6 quarters ahead. So perhaps, and to the extent that there isn't often a very good correlation between contemporaneous inflation and inflation 4 quarters ahead, maybe what you want to do is check policy rates where inflation was 4 quarters ahead. Now, this gets complicated if there are systematic forecast errors, because then you can't use realized inflation 4 quarters ahead. What you'll have to do is look at the inflation forecast that the RBI had in every MPC meeting, what inflation was a year ahead, and how policy rates move. So I think that may explain some of the perversity. The second is just, as you likely know, there's a lot of endogeneity here. There's a huge amount of endogeneity because output gaps and inflation affect policy rates and vice versa. So some work we had done about a year ago where we used GMM, a generalized method of moments. And once you control for that, you actually get much more sensible and conventional results. So I think that's suggestion number 2. The third is under inflation targeting, there was this stepwise framework where inflation, the target was moving over 4 years, 8 to 6 to 5 to 4. And therefore, maybe you want to see where inflation was vis-a-vis target, because it was not the absolute level of inflation, but the relative level that mattered in setting policy rates. And the fourth is perhaps augment the Taylor rule with an exchange rate variable, because the 2 rate hikes you spoke about in 2018 were explicitly undertaken because the exchange rate depreciated, even though contemporaneous inflation didn't respond. So I think once you make for these corrections, the results could be a little bit different. The second and final point I'll make is, I think ultimately, to Rajeswari's point, to judge the success or lack thereof, one has to look at whether inflation expectations are more anchored now. But the complication is we know that inflation expectations are very adaptive in India. And so to the extent that inflation has come off in the last 4 or 5 years, you would expect that to influence expectations. So how do you disentangle? There's an identification problem here. Are expectations lower because of the regime, or are expectations lower because realized inflation in the past has been lower? And what I would suggest is perhaps a more formal test. What we did a year ago was to see whether headline inflation converges to core or core inflation converges to headline. What we find interestingly is until 2013, core would converge to headline, but the last 6 or 7 years, headline converges to core, which is prima facie evidence that shocks to food and fuel are not getting generalized. And therefore, in a way that's a kind of suggestive that expectations are much more anchored today. And I think this way you circumvent the problem of dealing with these very noisy household surveys. But I'll end there. Excellent paper. And these are just some suggestions for the next round. Thank you.
Thank you very much, Sajid. Vijay Joshi and then Ajay Chebal.
Can I be heard?
Yeah.
Okay, my question is the good old question of the relationship between inflation targeting and exchange rate policy. It is quite noticeable that since 2014, the real exchange rate has appreciated considerably, and in the opinion of some people, including myself, undesirably. Now, the conventional view is that an inflation targeting regime cannot target the exchange rate as well. My question to the authors is, um, if they think that there is now a credible inflation targeting regime, does the credible inflation targeting regime permit occasional exchange rate management via serialized intervention and capital controls? I mean, this may become an issue that is important in future because a competitive exchange rate can sometimes be necessary for economic development. Thank you. That's it.
Thanks, Vijay. Ajay Shiva?
Yeah, thank you, Rakesh. And congratulations, Shekhar, for this forum and particularly for bringing this kind of paper also into it. I'm sorry, Poonam, I missed the presentation, but I have read the paper and I am actually very much along the lines of Rajeswari's comments on this paper. Particularly, I think, if you plot India's CPI inflation or WPI inflation, play around with a bit of leads and lags, you'll see that it tracks very well the global commodity prices. And much as we think that India's inflation has a lot to do with internal policy, I think in today's mostly globalized economy that India has, the global commodity prices play a very big role in determining inflation outcomes. So I think the fact that there's been this coincidence between inflation targeting and global commodity price declines can be attributed therefore to the success of IP is a bit dangerous. I mean, I don't agree with Raghu that it is, even if it's coincidental, what's wrong with it? Because if you don't have the right analysis of inflation, you could be actually doing a lot of harm if global commodity prices start to go up, and you think that you have to now tighten policy in the country through very high interest rates, you could actually be doing more damage than just benign sort of coincidence of the two sets of factors. So I think this requires far more analysis, and I'm glad there's a big review coming by the RBI itself. But I'm very much still have a very big question mark on the inflation targeting regime in India, not only on its efficacy, but on its very usefulness for a country like India at this stage of development. Thank you.
Thank you, Ajay. I guess it's now already 10 p.m. in India, so I can see the number of participants declining on a constant basis. So we'll close the panel, the audience questions, and I'll just go straight to the authors.
Rakesh, do you want to take one of our questions, at least one, from our attendees? They are on the chat. Pick any one. I don't know, Poonam.
I don't see any one asking for it in the chat.
Q&A. No, if you press the Q&A button, it'll start up. You choose. I can choose, or Poonam or Barry can choose.
You choose. Only one.
Right? There's a question question to Barry and to you and to Raghu. What do you think of the erosion of central bank independence and decreasing returns to monetary policy will have on a flexible inflation targeting going forwards? It's a very broad question, but nonetheless.
Okay, so I think I'll leave Barry to answer that because I've been restricting myself, because if I start, I won't stop. I'll just, before I ask Barry and Poonam to respond to the various comments, just a couple of comments from my side. The average inflation rates that Poonam gave for different periods, those periods were different from what's in the paper. But what was striking to me in the paper was that the average inflation for 10 years, from 1998 to 2008, was 4.9%, which is the same as the inflation targeting period. And with this, I think, very interesting conclusion from the paper that the RBI has really been a much more flexible inflation targeter giving as much attention to inflation as growth or output gap, then the question really is that if one actually analyzes what the RBI was doing, both in its statements as well as in its actual actions, in the 10-year period from 1998 to 2008, how different was it? Of course, the period from 2009 to 14 was exceptional in the sense of much, much higher inflation. Second, that in terms of the room that RBI has had in the COVID because of the anchoring. I have a real question there because in 2008-9, the RBI actually moved much more. In my personal view, which I'd expressed internally at that time as well, but my personal view, it was excessive. But it actually went down to 3.25% effectively because reverse repo was 3.25%, and that was the effective rate that translated into the overnight rates. And so it actually went from 9% effective rate to 3.25% in a very, very short period. As I said, my personal view is that that was going too far, but the argument that the RBI has had more room now because of anchoring doesn't hold water. That the much larger reduction perhaps did result, along with the government's fiscal expenditures, fiscal stimulus, in a much higher inflation rate for the next 4 or 5 years, yes, is very relevant. And finally, this issue of household expectations, that the household the inflation expectations haven't come down as much as the inflation has, which really is puzzling. I would make a comment there, which is that from, if I remember correctly, from 2005 or 6 to 8, when the inflation expectations survey had been introduced, the household expectations were not that different from the actual. And once again, should one conclude from that because inflation had been low for almost 10 years, that really did have an impact on household expectations, and maybe it'll take longer for the credibility to establish itself. And finally, on a lighter note, we all remember Zhou Enlai's comment when he was asked whether the French Revolution had been successful, and he said it's too early to tell. Barry or Poonam, whoever wants to go first.
I'm happy to go and leave Poonam the last word.
Okay.
Those were uniformly high quality comments. No research paper survives this forum entirely intact, and that's been proven again today. Let me touch on a few of the points. We agree that transmission is important for credibility of the framework, effectiveness of monetary policy, and that's on our to-do list if we're permitted to write an even longer paper. We're sensitive to the endogeneity issues, and the GMM estimates are in the appendix. Poonam will correct me eventually if I misremember, but I think we have looked at the exchange rate and the reaction function and didn't find much there, interestingly. Do these reaction function estimates show convincingly, prove that the RBI is now a more credible inflation targeter post-IT? Not by themselves, but that's why we have written a long paper. There is a bunch of ancillary evidence on how expectations react to actual inflation, how inflation in the future reacts to shocks to expectations. I think if you put the bits together, it makes a more convincing case than the reaction function alone, which we didn't want to emphasize to the exclusion of everything else. Household expectations are a problem, to be sure, but I would just observe they're a problem everywhere. They're a problem in the United States as well, where households consistently overestimate the actual rate of inflation or expect more inflation than materializes. Looking a quarter ahead, the professional forecasters' expectations seem to be more important for price setting in the relative sectors than the household expectations, interestingly. And if that's a robust finding, that's a little bit reassuring. Does this greater credibility, to the extent that it exists, permit the RBI to intervene in the foreign exchange market? Answer to that is clearly yes and no. It should facilitate occasional interventions in the foreign exchange market in response to occasional fluctuations in the exchange rate. But no, Vijay, I would not agree that it would permit the RBI to ensure that the exchange rate remains at levels consistent with the government's broader development strategy or whatever, independent of the inflation target. You started, it seemed to me, with the question, can it intervene occasionally? And you ended up with the question, can it target the exchange rate consistently? So yes to the first, no to the second. Finally, the meta question here is, are all these changes that we observe because of IT or because of other factors like different average levels of commodity prices or whatever? I've been tempted in the course of this project to do a synthetic control kind of exercise where you can construct a synthetic basket of other countries that have similar characteristics to India's, and then you see whether, except that they're not inflation targeters, and then you see whether there's a difference post 2016. The problem, of course, being that there isn't a basket of other countries as large and as distinctively Indian as India. I think doing synthetic control here would be a stretch.
Thank you, Barry. Poonam?
So let me just react to one or two broader points here. Not going into the details, not going into the technical questions in the interest of time, on how credible is the framework and whether it has served. And here my plea is to look at it in a relative sense. So compare India's current inflation targeting framework or monetary policy framework with the rest of the frameworks, whether it's regulatory, whether it's trade, whether it's fiscal. So in a relative sense, which framework is looking more credible, more predictable, and is just giving more policy certainty. And I would say it's inflation targeting more than anything else. Trade is 2 steps backwards, 1 step forward. Fiscal, we don't know whether we have an FRBM. Is it operating? Where is it going? Off budget, etc. Regulatory, again, I think it seems quite a chaotic regime at one level. So compared to, in a relative sense, I think monetary policy framework to me looks much more credible. Now, how do we capture or explain this credibility? And one answer could be actually quantitatively, it will be difficult for us to do it. I mean, if you divide up the period into the 2 governors, or just divide it halfway through to be objective, credibility was obtained in the first few quarters or first few monetary policy, when, as I showed, either the rate was not changed or it was even hiked twice and was not lowered despite a lot of clamor in the press that this is what we need. And maybe the fruits are being enjoyed in the second half when the need came and output gap opened, etc. Using that credibility, it was possible to respond. So that is how I would look at it. Of course, technical work, whatever we can do, we will be doing it. And as Raghu and Barry said, it's too early perhaps to answer all the questions, but changing it, I think, would be damaging too. I mean, so at least to me, looking at the data, I don't see any damages. I mean, one can question the benefits, have they been profound enough, etc. And if so, and if this credibility, I think it needs to be kept intact for some more time. And then let's see how the framework evolves and goes and what challenges come up. I think more or less I'll leave with this thought, unless there are other questions that need to be addressed.
Thank you very much, Poonam and Barry and Shekhar, for having induced Barry and Poonam to do this important paper, particularly at this juncture before 2021. Of course, I'm delighted that I had this opportunity to chair the session. on this very carefully done paper, and also the excellent commentary that we got from Ken Kletzer and Rajeswari Sengupta. So thank you all. For us, it's the middle of the day out here, and getting a little more civilized time for Barry and Ken. But for you, of course, it's getting a bit late. So all the very best to everyone, and thank you again, and hope to be able to participate tomorrow a little bit as well.
Thank you, Rakesh, and thank you to Barry and Poonam for really a superb paper, which I think is going to, excite a lot of further thinking and further writing, and just in time, obviously, for the 2021 review.
Shekhar, did you say further rioting?
No, I didn't. Let's not go into... No, there won't be rioting, I'm sure. We still don't know where the pandemic is going, and Delhi is, of course, trying to, get to be number one in India at least, but we'll see where it goes. But it's great to, have this group. It's great to be here. It's 10:15, and we still have more than 80 people in this conference. Thank you all for being here. Tomorrow is also going to be a very interesting day. I'll just take a minute to talk about the two topics and sessions we will have. A paper by Nirvikar Singh and Anirban Sanyal on heterogeneity in state performance, and looking at both structural change as well as economic growth, and then also push to think about how, as states behave differently, that can or cannot help the post-pandemic recovery. So Nirvikar and Anirban tomorrow, and then the final roundtable, which is going to sort of look at the overall growth picture and the overall jobs picture, and how that is affected, and what the lessons are from the pandemic. As you may have noticed, this India Policy Forum is an entire University of California takeover. Ken, Barry, Nirvikar, Karthik. So we certainly bow to those who woke up very early this morning, and here we are at the end of our day. So thank you all for joining us. We look forward to seeing you tomorrow. Really appreciate people staying on for this long. I see Arvind Panagaria, my former conspirator. Barry, Arvind, and I ran this for several years. Arvind, great to see you here. All of you, thank you very much. Have a good evening, have a good lunch wherever you are, and look forward to seeing you tomorrow. Bye-bye.